When you throw a lot of money into a supply-constrained segment of the economy, and what do? You get less output per dollar spent, essentially, is what happened. And it was not just a small decline. I mean, overall, construction productivity is down 10%. And most of that is due to the decline in res. So we have essentially eroded away our productive capacity to throwing money and getting less housing for it.
Welcome to Colliers Talks, a podcast series featuring the latest trends, insights, research, and developments in commercial real estate in Canada and beyond.
Okay, hello and welcome to Colliers Talks Economics. I'm your host, Adam. I'm the National Head of Research at Colliers, and today I'm thrilled to be joined by Pedro Antunes, Chief Economist at the Conference Board of Canada. Pedro leads a team of economists at the Conference Board focusing on thought leadership that you've probably seen in areas like productivity, the labor market, diversifying trade, the federal budget, human capital. He's a recognized spokesman for the Conference Board. He provides expert testimony to Parliament. He's regularly engaging with business leaders, the media, policymakers on the critical economic issues, of which there are many these days. So today we're going to focus a little less on the real estate side, a little more on Pedro's insights on productivity, the challenges we hear about so frequently for Canada, the labor market dynamics, hot topic for us, and the role of policy and tech in shaping economic outcomes. We'll talk a little bit about AI, which I don't think we've covered before. And we're going to help real estate owners, investors, developers just better understand how all these big forces and regional variations are going to inform the decisions in the year ahead. So welcome, Pedro. Thank you for joining us.
Well, thanks so much, Adam, for having me. It's a pleasure to be on.
Okay, this is going to be great. We have a lot to talk about. I'm going to start with something we've talked about a little bit: the budget. We had a new government last year. We had a new approach to the budget, a focus on investment, and with it, more debt, more spending, more long-term projects. And you have a public profile, Pedro, and I got to say you've expressed some skepticism about how effective this may be. I wonder if you can elaborate a bit. Like, there's the story of the federal budget is this going to boost productivity, it's going to boost investment, it's going to leverage the federal government's position to increase all those things. I like the sound of that, but like, what concerns you about the approach they're taking?
Yeah, well, I will start by saying that I do think we're at least focusing on the right issues. And I think it's been a long time since we've seen a budget that is really concerned and doing something about generating more private investment. And when we think about private investment, I always say we need to exclude residential investment. We need to look at private investment in the sense of what's adding to our productive capacity. And that includes things like structures. It includes, of course, machinery, equipment, IP investment, and all the talk these days is around resource projects or engineering type investments. These things are very important. And when we look back over recent history, what we've seen is essentially when oil prices tanked back in late 2014, we have essentially seen our share of private investment in these areas that I've just mentioned as a share of total GDP, of total income in the economy, really plummet. And it has not picked up since. So when we talk about what drives productivity, and I think this was something that we heard from the Bank of Canada, time and time again, around the most important effect on productivity is the amount of physical capital per worker, per hour worked. And, you can think of it very simply. I always talk about if I have a shovel versus, a backhoe, I'm going to get a lot less done with a shovel than if I had more machinery, more equipment to support that. So that's the example I've always given. The bank had talked about shovels versus snow blowers, but essentially we're talking about that buildup of physical capital. And the reason our productivity performance lags is because our investment, private investment as a share of GDP, is at 11%. The US is at 15%. You can imagine what a huge difference that is. And when we think about other competing countries, Germany, France, for example, developed economies, they're at 13, 14%. So I think there's a lot of things around productivity, but that is essentially the root cause. Now, why am I a little skeptical about the budget? Well, I mean, I think we're, aiming again at the right issues. The question is that catalyst effect that the federal government talked about. They said, we're going to invest in areas that are going to promote private investment to promote productivity. But when you look at the total amount, it's a big budget. Overall, we've leveraged about 176 billion in new spending over the 5-year planning horizon of the budget, but that's about 30 billion a year, roughly. That's about 1% of GDP. And, the prime minister is talking about the catalyst effect that would drive up about 100 billion essentially a year in private investment. And I just don't think we're going to get there, at least not very quickly. The major projects office, I think that's an important step that will, if we can, showcase some success in, allowing and how should I say, being quick around approval process, environmental approvals, and about the rules to get big resource projects going. And if those are a success, I think that will also help drive some investment, but it'll take time, and we won't get there as quickly, perhaps, as what the budget aims to do.
I think the time frame is something that's on our minds too, which is this. Okay, this sounds about right. You start to think about the time frame for something like high-speed rail, and the benefits are going to be reaped for literally decades. That's the case with a lot of these major projects, where if only we'd started 10 or 15 years ago, and we would have been in the same situation. But I think, the time frame is definitely a challenge. We're a slow-moving industry. We're an industry that's very dependent on infrastructure. So I think these are good things, but it's also it's just off on the horizon for us, unfortunately. Okay, let me talk about a hot topic in our area, which is Build Canada Homes. This focus on the policy level on housing, residential construction, development charges, all of that. But this is an area, this comes up at conferences. People debate about this, but productivity in that sector, you were saying, had actually declined in residential construction. As much money and time as is spent there, it's actually sort of going backwards. How can that be the case? Like, what went wrong there?
Yeah. Yeah, well, this is, I think, a warning or a word of warning around, yes, if we do want to build our infrastructure, let's talk about what we need to build Canada strong, if I can use the phrase from the federal government. Well, we need essentially infrastructure, transportation infrastructure, and that requires construction and, essentially productivity gains in those two areas, transportation and construction. And I go to the example that we saw over the last 2 years. As you know, we had very, very strong population growth, and especially in 23 and 2024. And that started to cool off a bit in 2025 because our policy around immigration has changed dramatically. We can talk about that later if you like. But the point here is, all of a sudden there was this surge in activity, or surge in how should I say, in the focus on building more housing. And so we saw federal and we saw provincial governments really focus on that. And essentially what happened was we threw an awful lot of money into a sector, let's say residential construction very specifically, that is supply constrained. We don't have the workers, we don't have the skills, perhaps we didn't have enough machinery and capital as well. And what happened? Well, productivity plummeted in 23, 24 in that segment. And we don't have the data yet for residential construction specifically in 2025. But if you look at the construction sector as a whole, we do have data for that. And that productivity continued to decline in 2025. So you throw a lot of money into a supply constrained segment of the economy. And what do you get? You get less output per dollar spent, essentially, is what happened. And it was not just a small decline. I mean, overall, construction productivity is down 10%. So, and most of that is due to the decline in res. So, we have essentially just eroded away our productive capacity to, essentially throwing money and getting less housing for it. So the word of warning here is, as we look ahead and as we look to essentially promote large infrastructure projects, promote resource sector development, we need to be really focused on the supply. And when I talk about the supply side, I think it's the labor issues. It's the skilled trades in those segments. And we need to be focused on that. We need to be focused on reskilling, retraining. And I've got to say, we need to be concerned a little bit about the steep reduction in or steep dramatic, in fact, change in our immigration policy, because we're actually going to see the supply of workers overall declining over the next few years if that policy sticks. And so you've got to be very careful about where you're going to find the workers to do all of the things that you do want to do.
Yeah, and we'll get to the whole demographics and immigration discussion shortly. Okay, that sounds good. So, when you talk about productivity, as you often do, and it's a conference board favorite topic, you often emphasize, let's not just look at a high level aggregate number. Let's slice and dice by region and by industry. So, tell us something positive, Pedro. We can talk about the negatives, like certain sectors that maybe aren't where productivity isn't growing or is even sliding backward. But let's talk about that. But also, I think we'd love to hear what's performing well, what's on the upswing is the area, resources, tech, finance, where we are seeing some growth there.
Yeah, no, I think it's, it's important to talk about aggregate productivity, our total income per hour worked. That's really important because that drives our prosperity. And it's good to have, big benchmarks around total investment, as I just mentioned. We could talk about innovation indicators. We could talk about other things that may affect our overall productivity picture. But I think what's much more interesting and much more telling is as you dig into what's going on at the industry level. And we have a very, very different performance on productivity when we dissect things in that way. So let me give you a few examples. I mean, we just talked about construction productivity. I think there's an issue there. It's been a long time laggard in terms of our overall productivity performance. And I think a lot of that has to do with essentially, it's a sector, especially on the res side, that is subdivided with a lot of industry players. So there's issues around our ability to drive, essentially, if how should I say, technology gains and big investments in the sector that, is essentially, kind of running a little bit, how should I say, in a way, almost over capacity. So we haven't had the time, and I think the effort to really invest in those segments. Competition may be an issue as well. As we know, our interprovincial trade barriers are still an issue in some of those areas. The other piece that I wanted to point out, and I highlighted a little bit, and I'm going to start with the negatives. Sorry, Adam, again, but is transportation productivity. And here there's a clear case. If you dissect that and get into the subsector level, what you see is that essentially, in almost every city across the country, we're using less public transit. That has led to a lot more road congestion. In fact, we see it in the productivity on public transit. There's less users, but the same amount of capital, same number of workers driving buses, driving trains, and so productivity has declined. That's led to congestion in cities, a huge increase in congestion, and that's driven productivity in trucking down as well. So those two segments then are now impacting rail and other, because of course trucking is so important in terms of other factors. So that's just another example. So those are the negatives. The positives, I think, are where we've shown great success in our country. We always focus on manufacturing and these kinds of jobs, but if you look at things like professional, scientific, technical services, if you look at essentially banking service, financial services, insurance, engineering, these kinds of jobs, professional services that are high-paying jobs, productivity and, in fact, output has done very, very well. And, I think we need to focus in the areas that we're doing well. If you look at private job creation, total private job creation in the business sector, that's, excluding public administration, health, education, private employment has grown by about 1% a year since 2015. In professional, scientific, technical services, it's grown at 4% a year. So we do have lots of success stories. We are, how should I say, we have comparative advantage in these areas. And when we look at how we're, it's not just domestic, we are actually driving services exports as well in some of these components.
It's interesting you say that. I think we certainly see that on the real estate side where as return to office accelerates here, I think a lot of companies are finding they are so much larger than they were. We talk about going back to the status quo of 2019 or something. Like your consulting, legal, accounting type companies are actually much larger than they were in 2019 because, as you're saying, these are the areas with the kind of outsized growth. There might be plateaus in a lot of other areas, but those downtown office type of jobs have actually accelerated more than perhaps it wasn't highly visible when we were all working from home, and now it's becoming much, much more evident. Okay. Well, I want to switch to the labor market and immigration, but one more question. I think that's kind of the transition. So we're talking about there maybe aren't enough employees in construction in these areas. Well, if we start building high-speed rail and pipelines and expanding ports, that's also going to have an impact. Like it's a necessary investment, but in the short term, this is going to impact the supply constraints even more, or is that not something to worry about? Like, how do you view the whole major projects push as intersecting with what you're describing of kind of shortages on the people side?
Yeah, no, I think it goes exactly to that. It goes to the issues of, I think we're already shy on skilled trades. I think we've seen our investment, especially in the energy sector, but on the resource sector, we're at large, those investments have come down from peak levels. I mean, if you look at the energy sector in 2014 or so, I think we had peaked at around $80 billion of investments a year. That's that continual flow that was happening at that time. It's dropped to less than half of that. And, I know we had some tough years, during the pandemic. Oil prices actually went negative, if you recall. That was a tough year for the energy sector. It's come back, but we're not seeing that reinvestment, of course. The world has changed, but we're not seeing that reinvestment in other areas as well. And I think our performance on approvals and, essentially the facility of doing big projects, especially in the resource sector in Canada, we've not showcased very well at all in these areas. So I think the focus changing now, and hopefully we'll have some success at rebuilding and enticing foreign investment in these areas. But remember what happened in 2022 when the economy reopened? We couldn't find the workers, right? Now it's a similar situation with the resource side investments and construction jobs in general. I think we're going to see a pickup in these areas, and I'm not sure the workforce is there. And that's why we're raising the flag, showcasing what happened in residential construction as an example of what not to do going forward. We need to be flexible on our immigration policy, and we need to be flexible around reskilling and retraining.
Okay, let's get into this whole job market, immigration, demographics, aging population, all that. So a lot of questions here. I often say that every chart for the pandemic looks the same. It goes up to record highs, it goes down to record lows, inflation, interest rates, immigration, whatever. And the job market is like this too. It goes up to unprecedented high unemployment, it goes way down, and now we find ourselves sort of back to normal, more or less. But I think there's a lot of nuance there. You're like, again, if we chop this up by region or by industry, there's a lot more variation. Like, okay, the headline unemployment, that's 6.5 or 7%. That's nothing crazy, but we have shortages on the one hand, and then maybe a very weak job market in some other areas. So can you elaborate, like what's going on beyond just the top headline number here?
Yeah, well, to your point, Adam, let's take it back to like just 2022, for example. So we had that closing the economy, where essentially a lot of people did lose their employment for a while, but the economy stayed closed, and we were supporting incomes with a lot of the federal and provincial government programs like CERB and others. So our incomes kind of held up, but then when we did start to reopen the economy, a lot of employers just couldn't find those workers anymore, right? We actually had a decline in, not a decline in total immigration, but a very steep drop in the inflows of immigration during the pandemic years. So what happened? Well, in 2022, you may remember early 2022, we had 1 million job vacancies in this country. That was double what we had in 2019, and it was already a tight labor market there. So what did the federal government do? Well, they said, okay, well, let's open the floodgates to non-permanent resident immigration. Now, what is non-permanent resident? It's temporary foreign workers, it's refugees, it's international students. And in addition to opening the floodgates and allowing lots of immigration to come into Canada, especially in those areas, we facilitated access for those folks to have more impact on the labor market. And we encouraged businesses, nothing wrong with that, we encourage businesses to hire more non-permanent residents. I think the issue I have on a more personal level is that if we really do need more workers, maybe it should be the permanent resident flows that we increase, not just this non-permanent resident flows. So these folks are here with essentially 1, 2, and 3 year work permits, depending on the cases. And we essentially saw in a couple of years there over 1 million total immigration. That's more than, like, we used to have immigration at 400,000, and then we were lifting it slowly to 450,000, and all of a sudden we got over 1.25 million immigrants coming into the country. Our population growth went from 1 to 3%, and now all of a sudden there's a backlash. People finding that with their affordability is an issue, the availability of housing is an issue. And we get into 2025, and the government essentially dramatically cuts back on non-permanent residents. A long story there, Adam. I apologize for that, but let me get into a little bit more of the details here. So the stock of non-permanent residents, the number of people that are here in the country, reached 7.3% at peak. And the government said, okay, now we want to bring that down to 5%. That's the target over the next two or 3 years. And what does that mean? That means outflowing, exiting, not renewing these work permits for 1 million people in Canada. So you hear about what's going on in the States in terms of numbers, what's going on in Canada in terms of the outflows. This is huge in comparison, 1 million people. So that brings our population growth now all of a sudden to negative, because the inflows are a net negative, with these people essentially not seeing their permits renewed, leaving the country. I know a lot of employers are very concerned because they have a lot of non-permanent residents on their workforce, and they're asking those folks, please let us know if your work permits are getting renewed. If not, we're going to have to exit you. So there's a challenge here, and I would say, going back to your point and the question that we raised, this is how should I say, the fit of those folks that are leaving versus the employees that we have in Canada. A lot of the non-permanent residents are working in accommodation and services and lower wage jobs. Do we have the Canadians to fill those roles? And then when we talk about engineering and construction and professional services, do we have the workers to fill those roles? So I think, just taking a broad stamp on immigration and shutting it down, essentially, it overlooks essentially the fit that we might have in the labor market. So we may have too few workers overall, but very weak employment growth, because I think the economic situation is not good at all. I mean, every day we're seemingly on the crosshairs of President Trump's policies. So we're not looking for a lot of strength in our economy and a lot of employment growth, but the mismatches, I think, are going to be very, very apparent going forward.
Yeah, and let's talk about that reduction, because I think that's been a huge surprise for us. Usually again, we're kind of a long-term industry. You're looking at investments this is not day trading or the currency market or the bond market. You're looking at, a 10-year or more time horizon. And demographics is usually the stable part. It's not something that's going to change. You kind of look out, you underwrite, okay, there's going to be a little bit of growth in population over time, aging population. So it's been very chaotic to have this yo-yo of this does not normally happen. I think we could agree that population growth, again, it's the same yo-yo. It goes to zero and then it goes to record highs and then it goes to zero. And then eventually, I think we agree it will settle out at some kind of normal-ish level, but maybe that's a couple years away. So what does that mean for employers? You've talked about like the real estate side, the downtown, like we've become sort of reliant on this, and now I think it's a little surprising how quickly it's been pulled back to zero. But where are we going to see the fallout for that the most?
Well, I think essentially, for the labor market, in some ways, it's positive. We're skewing the pendulum back to a tightening labor market, despite the fact that, again, employment growth is really quite weak. So it's both supply reductions and very weak overall job creation that are essentially tightening up the labor market. And again, the mismatches in the labor market, I think, are going to be what employers have to worry about. They're just a smaller pool of workers, a pool that's not growing, and that's going to be a challenge. And on the numbers, by the way, we've already seen, in fact, in 2025, through most of the year, we started to see net outflows of non-permanent residents. In the last quarter of 2025, it was 176,000 people that left the workforce on a non-permanent resident basis. There's a lot of questions about whether those folks actually leave the country or not. You may have heard some controversy over that, but I can tell you that their work permits are gone, and they're no longer, in principle, able to contribute to the workforce. The other thing I would say on the demographics, and here we talk perhaps a bit longer term, but for years and years, we've been talking about the last of the baby boomers exiting the workforce. This is in full force right now. The last of the baby boomers, the nose, if any of you had read David Foote's book way back, our demographer in Canada, the nose of the baby boom cohort is much more populous than the early boomers. And so the tail end boomers are now leaving the workforce in big numbers. They're still very much in the workforce. It's that, 60 to 65 to 66 age group, and those folks are in the workforce, and they're leaving at a rate of 300,000 people a year now. And so it's just another piece where we have this dichotomy in what's happening. You're losing, a lot of employers are losing workers with a lot of experience, and who's coming in to replace, and who are they going to be able to find to fill those vacancies. So a lot of challenges in the labor market. And again, on the slightly longer term, population was one of the most boring indicators. That and inflation for all of the years that I've been in the forecast business, population was 1% a year and inflation was 2% a year. Boy, have times changed. But yes, we saw population growth of 3% in the last few years. It was very, very strong. In 2025, it remained quite strong because at the start of the year was strong, even though the numbers were declining through the year. Now in 2026, negative. So a negative growth, and it's happening. It's like already in some of the numbers because the start of the year is so weak compared to where we were last year. So a couple of years of negatives as we get that proportion of non-permanent residents to 5%, and then we assume that we're going to see slightly positive growth. So we're going to average back to about 0.7, 0.8% growth per year over, say, the decade that follows.
Yeah, zero population growth cannot be the plan long term. I mean, it's not going to work. So I assume we get back to the normal level. But the more we look at the forecasts from you and others, it's more like that was supposed to be this year, and now we're starting to talk about maybe it's 2 years out or something like it's not an immediate reversal on that. Okay, the little bit more on the labor market again. It's the same kind of issue. Okay, there's a high-level national number, but when we slice and dice it, there's a lot of variation, especially with the trade war factored in here. You have your areas in Ontario where this is just about the worst thing that's ever happened. And then you have other areas of the country where it's more of a government center, it's more of a tourism center. Exports and imports is not a huge concern. So when we were looking at this recently, it's a bit, shocking how much higher unemployment is in Toronto and in Ontario generally than maybe some of your smaller metros or what you're seeing in BC or even Quebec. So like let's talk a little bit about like the regional variation and maybe the industry variation. We all know if for automotive metals, a couple areas, this is a huge shock, but maybe I think in our world of real estate, the impact on the downtown economy that you were talking about of lawyers and bankers and government employees and insurance, it's been a little more muted than we expected, I think. So yeah, if you could elaborate a bit on the regional side and the industry side of the job market beyond just unemployment has been going up for a couple of years.
Yeah, especially this year, there's some things that are kind of more or less universal. For example, on residential construction, we're seeing fairly weak segments across the country. And with a couple of exceptions here and there, prices are coming down, and we're going to see an easing in residential construction in general. So that's kind of a common theme. If you look at consumer spending, consumers are taxed. And, even though interest rates have come down, a lot of consumers, a lot of households took on a lot of debt in 2020, 21, and a lot of that debt is now being renewed. Those mortgages are being renewed because it's 5-year terms for the most part. And so they're being renewed. And instead of a 2% rate for the most part, they're being renewed at 4% rates. And so there's a lot of strain on households. And, we're worried about consumer spending. And that's been more or less a pillar across the economy in 2025. We're worried about that. And, as I mentioned, I don't think investment is going to kick in quick enough to really support for or allow for a strengthening in the economy. We're going to see a weakening in the economy this year. Now, having said that, as you mentioned, there are variations regionally. The tariff hit that we've had, the aggregate effective tariff on Canada is really quite low. When Prime Minister Carney says that we're one of the most luckiest nations in the world in terms of U.S. tariffs, he's absolutely right. Our effective tariff in the U.S. is running at about 14%. For Canada, it's probably around 4%, and that is because most of our products are getting to the U.S. without tariffs. It's only those tariffs under CUSMA compliant, right? Our free trade agreement. But if you look at aluminum, aluminum, by the way, is at half the value. The exports are at half the value that they were in 2024, for instance. Same thing for, not quite the same, but steep decline as well for steel. The auto sector is getting, feeling a really hard hit. If we can't get our auto sector into the U.S. market tariff-free, that is a real challenge. And of course, forestry products. And let's not forget, up until very recently, we had all sorts of challenges with our other biggest trading partner, and that was China. We've worked out some deals now on agri-food and a few other products, but that has been a challenge. So which provinces are the most affected? Quebec and Ontario at the bottom of the ranks for growth in 2026. Whereas if you look at especially Alberta, Saskatchewan, Manitoba, perhaps, they're doing a little bit better. Some of the eastern provinces, you mentioned tourism. Domestic tourism has been quite strong in the past year. So I think that's helped pick up the slack from the lack of U.S. tourists. And now with the trade deal with China, we may in fact see a resurgence of Chinese visitors. That's a big important market for BC, for example. So a lot of different things happening. I would say some of our provinces are doing fairly well. It's really Quebec. Most of our provinces are doing better, let's say, than the national averages, because it's Quebec and Ontario that are really at the bottom of the scale here. Very tough on the manufacturing side, this trade war with the U.S. And we talked about steel and aluminum, but tariffs, the U.S. tariffs on these products actually have all sorts of implications on the supply chain for things that we bring back into Canada for other manufacturing. So we're so how should I say, we're so tied to the U.S. in manufacturing that it just causes all sorts of challenges for us. Yeah, and then back to the services side, this is where I think things are doing a lot better. But again, the entire economy is not strong, so that does affect services like transportation, financial services. We talked about residential investment being weak. I'm glad to hear that on the commercial side things are looking up, and we're starting to see those vacancies in office space, as you mentioned, Adam. Come strengthening up, and so those are all good signs, but tough. The other thing I would say is we do have bargaining power at the U.S., but of course it's the president is mercurial in many ways, and who knows where we'll land on CUSMA. But there's a lot of risk in the forecast for this year. We're in our forecast hopeful that in 2027 we see a little more stability and allowing for our trade to pick up and a stronger economy then.
Sounds good. I feel I have to, before we go to the AI discussion, which I think everyone is waiting eagerly for, a very hot topic, like one real estate question, which is return to office is the story in our world right now. And you've talked about some of the issues, like the gridlock downtown is obviously another large story that's aligned with that. But I wonder if I could ask you about like the job market and return to office, because to us, it's a very strange reversal. Historically, good job market, good for downtown, good for the office sector, good for leasing, good for development, all that. But ever since the pandemic, that seems to be upside down. Strong job market means employees have leverage and don't want return to office, and hybrid is the norm. Weak job market, which we have now, means that things swing back to the employer, and there's like we're seeing the return to office momentum now. And a part of me wonders if it's largely just tied to the weakening economy. Like, have you seen that? We're struggling with so many of these where like the cause and effect seems a little different than maybe it was 5 or 10 years ago. But is it reductive to say that the job market, what's happening in the job market, is driving the return to office that we're seeing? I mean, there's always more than one factor, but I'd love your opinion on that.
Yeah, well, that's a really interesting point, and it's not something that I've dug into very much recently. I do know that back in 22, 23, when essentially the economy had reopened, there were a lot of employers and saying, "Oh, now you need to come back to the office." But guess what? Folks had moved. One of the hottest housing market in the country was North Bay, for instance. So a lot of folks that worked in Toronto decided to move to North Bay, and boy, they didn't want to come back. And so, yeah, employers were stuck. They had a very tight labor market. They couldn't afford to lose their workers, and so there was a lot of flexibility in return to the office. I do think the labor market has slackened. I mentioned the labor market will retighten, but it'll retighten slowly, and it will be very different across different segments of the economy. So I think for some employers, I think of especially on employers that have a lot of lower wage workers, and these are typically not office workers. They are going to see a more dramatic tightening of their labor market because of the exit of folks that are directly employed by these industries. I think more broadly, the labor market will stay slacker, as we just described. And I do think that this is going to be, I don't know exactly where the pendulum will sit industry by industry, but I do think this return to the office is something that will continue. Certainly, I'm in the Ottawa-Gatineau area, and, obviously that is changing dramatically here, where the federal government is pushing and is going to be pushing the rest of the public service now to move to 5 days a week, if I'm not mistaken. At the same time, of course, we have dramatic cuts announced in budget 2025 that will see the number of public sector workers in Ottawa coming down. So those two things together, I'm not sure how they'll pan out in terms of demand for office space, but some major changes happening across the country.
Okay. Now let's get to, okay, we talked about productivity, we talked about the labor market, but there's something looming over all of this for the last year, 2 years. The AI boom is upon us, and it's certainly trickled to the real estate world in the form of, I've never had so many questions about data centers and how many data centers are we building and where are we building them and how will we power them. But let's talk about it on the economy job market side. Like you've been optimistic on this. You've said that AI has the potential to really boost productivity. Is not going to harm it. So um, thrown out a number like it might even increase productivity by 10% over time. That's a pretty significant number. But can you unpack us that a little bit for us? Like what are we assuming about adoption, about the development of the technology over time? Walk us through it a bit.
Yeah, it's a very uncertain world with respect to the AI adoption and tech adoption more broadly, but AI specifically, I think, is the big factor. So, in the past, I've been at the board a long time. We talked about productivity, and it's an issue that we've been flogging for decades. How to get productivity up, and we were hopeful with the Internet of Things. We were hopeful that we would see productivity gains, and they were slow to be realized. And then there was this whole issue around robotics and automation. All of a sudden we're going to replace workers, and that was slow to be realized as well. It took a lot of pressure on the labor market before we saw some of that starting to occur. But I do think this is different. The AI, for one, it's very inexpensive. I mean, these are cloud-based technologies. They don't even show up as an investment. They show up as essentially a service provider, a cost that you may pay. And there are some investments required for specific bots, I guess is what they're called in the lingo. But these are minor in comparison to some of the adoption costs that we've had for other tech in the past. So um, the work that we've done has been essentially looking at what are the skills. So we first drilled down to occupations, and when we drilled down further on occupations, we drilled right down to skills, and then we look across each of these occupations and say, what are the skills that are used in that occupation for how much from how much of that occupation's time, and how much of that can be displaced by AI, and I think that is significant. And this is where we get numbers like 10, in fact, even bigger percentages overall in the labor market. The big question then becomes, how quickly do we see the adoption of this taking place? And if you get a 10% increase in productivity, that's very, very disruptive on the labor force if it happens quickly. If it happens over 10 years, it's still quite disruptive in the labor force. It's not quite a percent a year if you figure out the math, but it's significant. Think of our productivity at best has been growing at 0.4, 0.5, 0.6% a year. Imagine doubling the pace of our productivity growth. So this is something that I think will add to a lot of that uncertainty that we talked about earlier. Displacing certain areas of the economy, displacing workers perhaps in some areas, creating and generating demand for workers in other areas. And this is where I think we have to be very nimble. We have to be aware of what's going on. We have to keep, and when I say this, I mean we as employers, as government, as policymakers, we have to be flexible in adapting to the changes that may arise from this. We've been keeping a close eye, certainly, how quickly is this adoption happening? Is there any evidence of AI really just displacing jobs in the labor market yet? I don't think we're seeing it yet, but I think there's no doubt it's happening and it's going to happen. We work with a lot of HR professionals and executives at the conference board. These folks are essentially meeting with consultants. They're looking at their companies, looking at essentially what we just talked about. What are the occupations? What can be automated with AI? How much is the AI bot to take on that role? And so, this is happening. The other thing I'd say, you mentioned it, this is changing the world. If you look at the U.S. economy would be in the tank were it not for the investments that are happening in IP and data centers and electric power generation to feed the power needed for those data centers. The U.S. economy is, if you look at what's happening to consumers and businesses in traditional sectors, it's plateaued, it's flatlined really. If not for these sectors, we wouldn't see this massive growth. So it's the tech that is driving everything right now, and I believe it's going to have some important implications in terms of labor markets in this country.
And we're starting to see that when we drill into the data a little bit. There aren't a lot of, you mentioned the job vacancies and they're coming down. There are very few job vacancies in tech and finance and government. There are many more job vacancies in the things that AI isn't so good at, like being a bartender and cleaning a hotel room and logging and farming. And that now perhaps there's a world where drones do all the farming eventually or something. But like it fair to say that we're seeing the AI adoption have much faster and more significant impact on the sort of white collar, for lack of a better word, world of work. You said you're talking to HR leaders. Like, what kind of jobs is this really impacting? Is it like, I don't want to be too doomer here, but I think like there's a lot of variation in terms of like where is the highest value for this, or where are companies implementing it the most?
Yeah, no, you're absolutely right. And again, we haven't seen a lot of evidence yet. Certainly, there's been a lot of talk about programmers, for example, some of these big tech firms, essentially laying off the folks in these tech areas. But I do think this is a professional, and I do worry about, because on the one hand, this is where we've had this comparative advantage and lots of labor market and employment growth in the past decade. But at the same time, it is professional services where we can see a lot of disruption and displacement happening. Yeah, and you're absolutely right. When HR leaders are looking at these roles, these are professional service roles in all sorts of ways. Now, I do think that we can't disregard the fact that a productivity gain is a positive, right? A productivity gain means that we can do more with the same number of workers, and that just drives up our incomes and drives up our prosperity, drives up government tax revenues, and helps us do more with less, essentially. The question is, short term, what are the disruptions that might happen? How can we ensure that we support folks that are displaced, and to ensure that we get them back in the labor market as quickly as possible? So retraining, reskilling is going to be really important. And the agility and the speed that we are able to do that is really important as well, because retraining takes time. If you lose your job in a sector, it takes time to retrain. It may take time to get reemployed. And these are costly to the individual and costly to the economy. The last piece that I could add to all of this is just to remind everyone that we have been for decades now a labor-constrained economy. Immigration has been helping us fill the gap in many respects. And I think, again, we need to align our immigration policy to the needs of the labor market. And so in general, for the next couple of years, we've got this challenge of declining population growth overall. We've got the baby boomers that are leaving the workforce in big numbers. So there's an opportunity here to not necessarily disrupt and displace workers, but just to fill that gap with kind of a more productive workforce, hopefully. So, this is what's panning out in the next 4 or 5 years. And longer term, I think, we'll have to see at how quick a pace this adoption happens.
Okay. And like, I would say our industry is perhaps not the leading edge technologically, but as a final question, like, how should we be thinking about AI in the real estate world? Like, it's a bricks and mortar kind of world, but it's also one that's highly exposed to kind of fundamentals, demographics, labor market, interest rates. Like, all of this is highly influential. So like, not that AI will solve all our problems, but where does it fit in the, some of the sectors we talk about a lot, like retail, hospitality, office, warehouse. Like, this is where we're spending our time. Like, how is AI going to play out, and how should we think about it in the real estate world?
Well, I think it'll play out in all of those areas. I talked about the services in terms of adoption, professional services in particular, but it's being applied everywhere. And in fact, everything from airplane maintenance to warehousing and all of these things. And there's some clear examples out there. Retail, for example, there's massive changes happening. It's already happened in retail in terms of online shopping and others. So I do think I can't speak to all of those industry sectors because, again, this is a nascent technology. The work we've done is really on the occupational side, looking at that disruption on the labor supply side. Labor demand side, I guess, if you look at it that way. Yeah, I do think it will affect, we just need to keep our ear to the ground because it will be affecting everywhere, all industries. With respect to specifically the commercial real estate sector, I don't know. I think that's a sector that, how should I say, a people sector. Perhaps there's a little less displacement that would happen there and across, more broadly. But, I think we just need to be aware and focused on where the changes might be coming.
Oh, yes, it will be coming for us as well. Anyway, this has been a great discussion. Thank you, Pedro, for joining us, sharing your insight on productivity, labor market, the economic forces that we're dealing with in the economy, and of course, the real estate markets. It's been a pleasure having you on the show. Thank you to everyone listening and watching this episode of Colliers Talks, and we really appreciate your time and hope today's conversation was thought-provoking, practical, useful in your own decision-making. So be sure to join us next time for more expert insights and in-depth conversation. And until then, take care.
Take care, everyone.
Thanks for listening to Colliers Talks podcast. To learn more about Colliers Canada, our experts, and our solutions, visit collierscanada.com or find us on LinkedIn, Twitter, and Facebook.